Hi, I'm Jeff Roth with EchoTrade, and I'm here with John Wells from Morrison Wells. John's got 20 years of experience, investment experience, hedge fund background, and we're here to talk about their concentrated opportunity strategy within EchoTrade. So thanks for being here, John.
Good afternoon, Jeff. No problem. Glad to be here.
Yeah. So first off, let's dive right into the portfolio. What are the overall goals of the strategy? Is this focused on trying to just grow the portfolio as much as possible, purely growth, or is it income generation, capital preservation? What are the goals?
Now, our strategy is a total return strategy geared towards growth and long-term capital gains. There is an income component to it. I would say that the yield of the portfolio is probably in the 1.5 to 2.5% range right now. But the goal is definitely to generate capital returns with a 3 to 5 year time horizon for each investment.
Gotcha. So each company that you're investing in, you're looking at holding that for 3 to 5 years.
That's right. A 3 to 5 year holding period, as well as a 50 to 100% gain per security. And so what ends up happening is that some of the investments exceed those expectations. Some of them underperform those expectations, and some of them fit within the range. And the results of that are the portfolio. And more so than a specific return target for each security, doing the analysis and having the ability to potentially capture that sort of return profile gives us a margin of safety to the downside. So we're looking at companies that we think can grow and appreciate to that degree, and companies that we think are fairly safe when it comes to downside protection.
Got it. So you could be holding on to positions again for 3 to 5 years, or you could, take returns early, or if they're underperforming and things change, you could be exiting early before that time horizon as well.
That's right, Jeff. There's always one or two names that are in our Morrison Wells penalty box. So, names that have underperformed operationally for one reason or another, and that we're keeping close tabs on and reevaluating constantly. And likewise, we have a couple of names in the portfolio right now that we've held for over a decade.
Got it. So that leads to a bunch of questions that we'll get into later, kind of more into how you guys determine what you're going to put in the portfolio. But before we get into that, just kind of on a more broader scale, why did you guys choose this portfolio for EchoTrade? There's a lot of different investment philosophies and strategies you could have chosen from. Why did you guys choose this one, and why specifically to offer on EchoTrade?
Yeah, this is also a great question, Jeff. We, as a firm at the moment, actually only have one equity investment strategy. So you might be a client who comes to our firm, and your risk profile and your financial goals determine a 100% allocation to equities. Or you might be somebody who comes to us and really maybe you should have a 25% allocation to equities. And those two risk profiles will actually have the same portfolio. We believe in one optimal portfolio that somebody in theory, a client in theory, could allocate their entire paper wealth, financial wealth to. So we essentially have one optimal strategy, and we are hard to be classified by someone like a Morningstar. We're not purely a value investor. We're not purely a growth investor. Our investments, as the Echo traders can see in the portfolio, they are across a range of market capitalizations. We're really looking for opportunity where we see it, and we're kind of willing to go anywhere to do that. And that includes, a lot of investment firms will have percentage required minimum percentage allocations to different industries. We were out of, this is just an example, but we were out of the banking and / financial services sector from 2007 all the way to 2013. So we can tilt the the overweight, if you want to call it that, or underweight of different industries pretty widely to hopefully find optimal returns for our clients.
No, and that's a good point to bring that up. That there are different types of portfolios that are quote unquote sleeves, or they're like you said, they're have a mandate to be invested in certain sectors, right? And so you guys are more of a holistic portfolio that, like you said, as an investor, I can just have this one portfolio, and then I don't need to add different strategies to kind of balance out a broader portfolio. So that's definitely good to know. And then so like you were talking about your existing client base. And so, your existing kind of high net worth and high net worth families and individuals, what's your typical client look like? What's your typical client profile? What's the typical account size of the clients that you're working with, today and previously?
I would say that our typical client profile, our typical account size is around $3 million. But there's a pretty wide range there, from $40 million to $300,000. We don't
Yeah.
have a client account minimum at this point in time. And we would really like to help younger people with a propensity to save and also earn, grow their nest egg. Our client base today does skew a little older. I would say, average age is over 55 to 60. We manage probably half of the money is in qualified accounts, so IRAs or some form of retirement account. And we have folks ranging from entrepreneurs to people who've had big cash outs from selling a business to a public company, all the way to the millionaire next door. We're based in a college town, so we get a number of professors and administrative people from the university rolling their retirements over to us to manage in their later years. And those folks have been diligent savers with a good plan, supporting them, putting money away, and so their account size matches what I described. So that's the typical client.
Gotcha. And so, I mean, like you mentioned that, with the concentrated opportunity portfolio, obviously EchoTrade was built, not for the guy who's got $3 million on average, or even 300,000. We're trying to
Right.
give greater access. So, the concentrated opportunity portfolio is built for EchoTrade. So, but have you been investing something similarly for your client base previously, so that we can look at maybe what the broader track record, in the last 5 or 10 years has looked like, if you have any performance information on a portfolio similar to the one that's offered in EchoTrade?
Right. So part of the reason that Morrison Wells wanted to start to work with EchoTrade is we wanted to be able to serve that client who may not have had a chance to accumulate vast wealth at this point, but help them get to that point. And so the
Yeah.
portfolio that an EchoTrader would see on through the EchoTrade portal is almost exactly the portfolio that we run for our clients. And again, it's the idea that there's an optimal portfolio out there. We really don't think that somebody with $30 million, necessarily should have a vastly different portfolio if their goals are the same as somebody, who has $5,000. We think each of those clients should receive our best ideas, and our best ideas are in the Morrison Wells concentrated opportunity portfolio.
That's great. So an EchoTrade investor with, like you said, $5,000, they can be investing in the same portfolio that a $30 million client has, and so they're investing just like the wealthy, like the top 1%. Yeah.
No, that's exactly right.
So that's great. And then so along those lines, like, talk about risk. Obviously, very important. So anybody that's kind of looking at the concentrated opportunity portfolio, what's the risk tolerance for me? What should I be willing to risk? It's low, medium, high. I think you guys are along the middle ground on that, and how would you define that?
So the industry, Jeff, is going to categorize Morrison Wells concentrated opportunity as high risk.
Mm-hmm.
And I would like to share with you why I think that maybe that's a misjudgment.
Yeah.
Our portfolio, it currently has 20 names in it, and we think we subscribe to the academic study that after about 15 investments, the marginal benefit of diversification is very little. So that number we agree is probably 15. We hold 20 names, and so anyone invested in our portfolio, we believe is diversified from company specific risk. Something unforeseen happening in the stock price of one company going down. We think the portfolio is diversified enough to protect against that sort of event. Our portfolio is likely to have more volatility, which is the industry standard measure of risk, and that just means how the balance goes up and down. Because there are less names, and each name has a greater impact on how the portfolio moves. That being said, our firm doesn't necessarily agree that volatility is the correct definition of risk. In fact, our clients probably get tired of how much we preach that volatility is opportunity. So just as an example, when the S&P 500 really tanked in late March into early April 2020, as it related to the coming at that time coronavirus pandemic, that was broadly a negative. Everything involved around that, but because there are only 20 names in the portfolio, we repositioned the portfolio almost fully at that point. There is at least 50% turnover, which means the percentage of the portfolio that we changed, but probably closer to 80%. And the stocks that we invested in the beginning of April 2020, they became what the industry and what the investment news media referred to as the work from home stocks. So our clients benefited from volatility, or what the industry calls risk. We consider risk to be the permanent impairment of capital, meaning a company goes bankrupt, or a stock declines in value because there's something going on at the company that cannot be changed. So we want to make sure that we have companies with strong balance sheets, strong cash flow generation, high returns on invested capital, and we protect against the downside by doing that. I referenced earlier the 2008 housing crash. So our portfolio was down in line, almost exactly in line with the S&P 500. And that was without holding bank stocks. And if we maintained the holdings in our bank stocks, which we sold in March 2007, the portfolio would have been down a lot more than that. But we made some moves in early 2009 that led to 25 percentage points outperformance versus the S&P in 2009. So we the industry would classify us as high risk, but we think we manage risk well enough that this portfolio, one would have no problem putting all of their equity allocation in this portfolio. It's a little bit of a different take and maybe a differentiator for us versus the industry. We also think that we can know 20 names far better than we can know 100 or 150 different investments in a portfolio. There are many ways to invest, but this is the way that we that can be successful. But this is the way that we think we have the most control over and the most potential to beat the S&P 500 over a longer period of time. And to reference your question just regarding performance, we have a verified track record in the equity portfolio that dates back to 2020. And if you take it 1 year before that into 99, over the last 23 years, our portfolio on a net basis for that composite, the industry description, in terms of calculating a performance, it's referred to as a composite. Our stock composite has returned about 9.8% net per year over that period of time. And I believe, this is off the top of my head, I think the S&P 500 has done about 6.4% net annualized over that period of time. And Warren Buffett, Berkshire Hathaway, widely regarded as one of the greatest investors of all time. I want to say that Berkshire over that same stretch of time did 8.7% annualized. So, our annual performance over that time gives, something close to a doubling of the S&P 500 in that period of time. And that's what we want to do over a 20-year period, or let's shorten that and say over a 10-year period. We want to show some form of outperformance versus the S&P 500. We know we're not going to compete with it on an annual basis. Some years, like last year, we underperformed the S&P 500 by a point or so, and this year we're a few points above it. But we want those returns to stack over time and show strong performance over time.
Yeah, that's incredible. I mean, 3 points annually and then extrapolated, like you said, you're basically doubling that, and you're beating Buffett. So
Yeah.
the investors in EchoTrade can to take that to heart. So, I mean, I think we've covered a lot here. I mean, I think we kind of dive a little bit, I guess, into the portfolio a little bit more in terms of what you guys are investing in. So it sounds like you guys are primarily investing in individual names, individual companies, and not like ETFs or anything, correct?
That's right. Sorry, we didn't cover that, but yes, the 20 positions I referenced in the portfolio are all individual equities, and it ranges across a number of industries. Pretty much all industries. We don't hold any utilities. There are a couple of other small industries that we don't have exposure to at the moment. But we hold individual companies. And our, probably by how I've described us so far, you and the viewers will understand that we're opportunistic. So we're looking for value wherever we can find it. And just two quick examples: we hold 2 cybersecurity stocks within the EchoTrade, within our portfolio, but within Morrison Wells' concentrated opportunity on EchoTrade. And cybersecurity, we would love to own more of it. The 2 names that we own, so right, two names in a 20-name portfolio, that's 10%. That's pretty large exposure, but that expresses our conviction in the industry. So with that investment specifically, we started with an industry theme, believing and analyzing and realizing that the cybersecurity industry has a lot of tailwind behind it, and still more to go. So we wanted exposure, and we found companies that were a blend of high quality companies that at the time were lower valued companies than maybe some of the other names that we could have invested in. We do regardless of everything I've said so far, we do have a view on value. So it's very difficult for us to go out and buy something like an NVIDIA today at 35 times sales.
Mm-hmm.
That's probably not saying never, but that's probably not our bailiwick. So the names we owned in cybersecurity, when we bought them, one was trading at 12 times earnings and one was trading at 16 times earnings. Fortunately, both names have had some PE expansion, but their underlying operations have grown a lot over the last few years too. So that's an area that started with an industry theme and led to 2 holdings, or 10% of the portfolio being held in cybersecurity. Another, just to give the viewers and to give the Echo traders a little more feel for the portfolio. We also have investments in the portfolio that start as a one-off thesis. Through our research, we've come across an individual name. Like I won't name it, but we hold a electrical parts manufacturer and distributor. Company that looks very cheap to us right now, has they've done management's done an amazing job with capital allocation. We think there's a lot of opportunity ahead, and that the name was discounted based on fears of recession. That name crossed our desks just in our day-to-day reading and staying current on sectors and companies within those sectors. So we can source our ideas from anywhere, really. But I hope I gave you a little bit of a flavor of two totally different ways that we've done so, over the last few years.
Yeah, no, that's super helpful. I mean, like you said, I mean, it's a good name, concentrated opportunity. You guys are opportunistic. You're agnostic in terms of market capitalization. You're agnostic in terms of sector, but you will look at different themes and sectors and overweight depending on where the opportunity lies. So I think that's perfect. And it kind of leads me into, and you covered it a little bit. But so what's the investment process? How do you guys go about choosing a certain company, to include in the portfolio? What's your kind of vetting process? What kind of research do you guys do before you, make the decision to put a certain, company or name into the portfolio?
Yeah, we have a very strong background within the firm in the CFA program, the Chartered Financial Analyst program.
Mm-hmm.
So our process is a mixture of quantitative analysis, looking at financial statements, looking at SEC source documents from these companies, determining whether what they are saying to the public, to the investment public, is the same as what we see in the numbers. And finding companies that, based on past and future our future projections, look undervalued. So there's we, on some of our investments, we start from a very quantitative sort of screening process initially, and then on some of the investments we start from a top-down approach, observing and reading and following, seeing different sectors that are interesting.
And top down, not to
then
cut you
digging in.
off, but just so the investors know, top down meaning you're looking, kind of thematic and sector based versus looking at an individual name bottom up.
That's right, Jeff. That's right. And it was the fall of, as an example of that, the fall of 2021. I think the oil and gas sector was probably one of the most hated sectors out there. It was sort of the peak of interest. To date, I think we'll still see continued interest in it, but it was the peak of interest in environmental, social, and governance issues
Mm-hmm.
by fund managers and by investors. And oil and gas, was hated. So we
Mm-hmm.
dug in. That industry has changed their return on capital profile, meaning that they've improved it. They've become less. They've become less indebted, and then they benefited from a rise in oil price also. And so we held two oil companies during that period. There are actually none currently in the portfolio today, but that was an example of taking advantage of what we saw as a dislocation from almost a macroeconomic perspective, or just I guess a psychological perspective that had driven the prices of these companies down. So we're looking for things. We're looking for dislocations like that, as well as finding companies that have screened very well for growth, but for whatever reason their stock prices is depressed. So our research process is much like the portfolio itself. It's fairly eclectic, and we really don't we don't have to get all of our ideas from the same place or same source. Interestingly, the firm itself, before being renamed to Morrison Wells on January 1st, the firm itself has been around since 1975. And we do not subscribe essentially to almost any Wall Street research. So we do our research from a fairly small college town in the state of Virginia. We're away from the hustle and bustle of either New York or the Bay Area. And in this location, we're fairly uninfluenced by others and by the financial media or Wall Street analysts, and we can pick through the company's financial statements and go through their conference calls and form our own opinions. And I think that's been a great advantage on the research side as well.
That's great. That's great. And so finally, I guess we're two more quick questions in terms of, we touched on this a little bit, but just the amount of activity in the portfolio, the frequency of any position changes or new trades, what's kind of typical. And like you said, it can be very, different, what you have, COVID or the 2008
Yeah.
banking crisis, or we have the bank crisis this year, that different conditions can affect that. But typically, what would you expect in terms of how often you guys are turning over the portfolio, how many trades to expect per year?
Yeah, no, that great question, Jeff. And I don't want to be boring for the echo traders out there, but our portfolio turnover is probably about 20% per year. So 4 in and out trades per year is our average. But that's an average, and the numbers can vary pretty widely. So to your point, and it's funny that you pulled out those those examples, but during the COVID crash of early 2020, like I said, I would say we probably turned over about 80% of the portfolio.
Mm-hmm.
But then this year during the banking crisis, when stock market valuations came down pretty significantly again, strangely, in that March to April timeframe, we had zero turnover. The banking crisis itself wasn't going to change how companies within our portfolio did business and how they generated revenue. And so we felt pretty strongly about each name in the portfolio, and we came through the banking crisis without any changes, which is in stark contrast to what the COVID time period gave us, where our names were going to be significantly affected, especially if people were locked inside for a long time. And the research committee, the investment committee here, differentiated between those two things or those two situations, and had vastly different outcomes.
Got it. Great. And I mean, that kind of the last question about the portfolio, it seems, again, you guys are relatively agnostic. I mean, right now we're in an inflationary period or coming out of, there's a, pending recession, or some say we're in the recession. Is this portfolio built for any certain type of market condition, or that this addresses, or is it, kind of can, like you said, kind of move in and out depending on the circumstances?
Right. So I would say that we can certainly make changes to the portfolio depending upon the environment. I would say that we are in a recession already. We've got a lot of data points to back that up. But just because we are in a recession doesn't necessarily mean that the portfolio or the market generally has to go down the tubes. There's definitely data out there that shows that EPS declines in a recessionary environment don't necessarily mean stock declines. And our portfolio, because of the diversification in it, we're not going to go 100% into things that might stand a recession / market downturn. Our portfolio will definitely go down when the market goes down. And the question is to what degree. And I think we hold names today that have the sort of the balance sheets and the operational savvy to do better than most companies in a recession. But in a down stock market environment, our portfolio will go down. I referenced earlier that we were down in line with the S&P 500 in 2008. Interestingly, we did better than the S&P 500 during COVID, but going further back in time than that, to the .com crash, our portfolio was actually not down in 2000, 2001, 2002. The portfolio was actually up, and that was because money was flowing out of the technology names and the high flyers of the day and into the names that we held. We held stuff like W. Granger and Procter and Gamble and Coca-Cola, names that were at the time sort of more value names and defensive in posture. So, a recession or a stock market downturn doesn't have to mean that our portfolio goes down, but I would want the echo traders to know that we're not creating a portfolio that isn't going to go down if the market goes down. And our main goal is to manage through that volatility, that downside, and create significant gains over time. Again, I'll go back to what I said earlier, that we truly view volatility as opportunity for our clients and for ourselves.
Yeah, that's great. That's great. I think lastly is just give us a little bit of background on yourself. So John, why should I trust you? Why should I be following and copying your portfolio?
No, that's a good question too. So my background is that I went to the University of Virginia and graduated with a degree in commerce in 2001, and then I went to work for somebody that nobody knew anything about at the time, but his name was Howard Shillett, and he ran a business called the Center for Financial Research and Analysis, CFRA, which still exists today, even though he sold out of it a long time ago. And basically what we did there is we looked at companies' financial statements, and it wasn't common back then, but it is common today, and made judgments on whether what the companies were telling Wall Street was the same as what we saw through the financial statements. And so the early 2000s in particular were just a great period of essentially financial shenanigans, which is the title of Howard's book, and common industry term these days. And so the phone was ringing daily with clients wanting to sign up and find out what the next financial accounting fraud was. I mean, this is in the time of Enron and WorldCom and so forth. And so from there, I went to go and work for one of our clients at a hedge fund in New York City, where we primarily focused on European and international markets. Then I went as an analyst to a hedge fund based in Philadelphia, Pennsylvania, and primarily covered U.S. retail stocks. And then my wife left grad school in Philadelphia, and we moved to Charlottesville, Virginia, where I found a company called Darrell & King. And luckily, they were looking for somebody at the same time I was looking for them. And 12 years later, my name is on the door here, as we announced on January 1st that we were changing the name of the firm from Darrell & King to Morris & Wells Wealth Management. Beth Morris is my partner now, and Jack, who founded Darrell & King, and Charlie are still here working actively. But we just wanted to let our clients know that we would be here for the next 20 years. So I've loved working here, and if I was starting something myself, it would be with the same strategy and the same sort of founding principles. So it's kind of a perfect fit from the get-go 12 years ago. And then also something that echo traders should know is that my personal portfolio, my personal wealth is invested in the same portfolio that we are offering to them and to our other clients. And that's something that I strongly believe should be aligned with clients. So eating our own cooking, so to speak. And those are the reasons that I think that echo traders should trust us and stay with us for a little while to see how the portfolio proceeds along. One thing that I've posted on the Echo Trade site is a number of things, but one thing for investors with maybe $5,000 or in that realm to continuously add money to your account when you can. Don't try to time the market or anything like that. And over time, I think this platform, this Echo Trade platform, gives you a significant opportunity to to build wealth. And I know there are some great investors and investment firms on the platform.
No, that's fantastic. Thanks, John, and thanks a lot for partnering with us and giving Echo traders access to the portfolios. And appreciate the time. And we'll I'm sure we'll be in touch and have another one of these soon.
Great. Thanks, Jeff. It was a pleasure. And to all the Echo traders out there, good luck. Take care.
Thanks, John.